Okay, so this is also known as the Savers Credit. It's calculated on Form 8880. Eligible individuals, this is where you get that rare opportunity to double dip, where you can get a credit for something that also was never taxable, or that you got a deduction for. So for individuals, as long as they meet the income requirements, if they contribute to a retirement plan, and that could be that they contribute themselves individually to an IRA maybe, and then they would get a deduction for that IRA on the Schedule 1. So it would reduce their taxable income, or they contribute through their employer. Maybe they contribute to a 401k or a 403b, any of those types of retirement plans. If they meet income qualifications, in addition to it reducing taxable income, the amount of their contribution reducing taxable income, they can also get a credit for it. So in some instances, essentially, you contribute and it ends up not being your money that you contribute to your retirement account. You get the savings that you get in taxes more than makes up for much of the contribution that you made. So if you could make a $2,000 contribution, but it turns out that you get a $1,700 tax credit, it combined with $1,700 tax savings from the deductibility of that, then you've paid $300 of your money, but you've gotten a $2,000 contribution to your retirement that will presumably grow. So eligible individuals can take a tax credit based on contributions toward a retirement account multiplied by an applicable percentage. The percentage ranges from 0% to 50%. The 50% is for lower, the more your income increases, the more the percentage decreases. The contributions can be made to an IRA, traditional or Roth, 401k, 403b, 457, simple plan, or some other qualified retirement plan. So any distributions in the same year from those retirement accounts will reduce the amount of the contribution that you can that is eligible for the credit. Modified AGI, same definition as before. The maximum contribution amount for the credit is $2,000 per person, so that's the amount contributed to the retirement account. The maximum that can qualify for the credit is $2,000 per person, $2,000 for each spouse if they're married. So here is what the 8880 looks like, and there's a column here for you and for your spouse. These are the income ranges and the applicable percentage of the credit that you can use. So if your line 8, which is your modified adjusted gross income, here, line 8, is under $23,000, up to $2,000 of contribution, you can get 50% credit on that. So you get $1,000 credit. If it's both you and your spouse, you each get that, and you each contributed that $2,000, then you each get $1,000 credit for that. So essentially, you're getting half of your money back in the form of reduced taxes. This is not a refundable credit, however. So, the lower your taxable income or your AGI, the lower the chance that you actually have a tax liability. But for those that kind of fall just right, it can be a really valuable credit. So you can see it phases out at $76,500 if you're married filing jointly. So it phases out for head of household at $57,375, and it phases out for any other filing status at $38,250. So, but those percentages only apply to the first $2,000 that you contribute. So if you contribute $10,000 to your retirement fund, you're still only going to be able to apply $2,000 with regard to calculating the amount of the credit. But if you do it right, you could contribute additional amounts to your retirement and bring your AGI down to a level where you actually qualify then for the credit. So there is some tax planning advantages that can be used there. So here's also the income levels for joint, head of household, all other filing statuses. So if a joint return up to $46,000 of modified adjusted gross income can be entitled to up to 50% of the first $2,000 per taxpayer that contributes to a retirement plan. So essentially what that means, well, maybe they've got an example here. So we got Hector is single with a modified adjusted gross income of $26,000. Okay, so all other, so between 23 and 20, no, he's 26. Between 25 and 38,250. Boy, this is that 20% is a really small range. It's only $2,000. So he's at 26,000, which means he gets a 10% credit, 10% of the amount of his contribution up to $2,000 contribution. So he's going to get a $100 credit. If his modified AGI was $23,000, he would get a $500 credit. So he would get $50,000. So not over $23,000, over $23,000. So what I would tell Hector is, dude, why don't you, if you can, make an additional contribution to your retirement account, make an additional $3,000 contribution to your retirement account over the year, because that will bring your AGI down to the level where you're getting not only are you reducing your AGI and reducing your taxable income, you're also going to increase the amount of credit that you get from this particular credit. So, like I said, some tax planning opportunities there. We got Bo and Rochelle married filing jointly, modified AGI of $47,900. All right, so they are here, $47,900. So they get 20% up to $2,000. Bo made a $2,000 contribution. Credit is $400. If both of them made a $2,000 contribution, they would get $800 because each of them gets that $400 credit. So, like I said, it's a rare opportunity to double dip where you get a deduction as well as a credit for the same money. That's astounding. That's wonderful. Any questions about that?